There's a pattern in economic history that repeats with mechanical precision. It doesn't happen randomly. It happens when specific conditions align. Extreme asset valuations, record debt, excessive leverage, widespread belief that this time is different, and a trigger event that sparks the liquidation. These conditions existed in 1929. They existed in 2008. Right now, in 2025, every single condition is present again. Not similar, identical. If history is any guide, the crash will come in late 2026 or early 2027. This isn't prophecy. It's pattern recognition. The current situation, January 2025. The largest everything bubble in history. Stock market at all-time highs. Housing. U.S. median home price is $420,000. Median household income is $75,000. A ratio of 5.6 to 1. The historically sustainable ratio is 3 to 1. Current home prices are 87% overvalued relative to income. The 2006 housing crash peak was 5.0. We're higher now. Corporate debt. Non-financial corporate debt is $13.5 trillion, 72% of GDP. In 2007, it was 43%. Government debt, $36 trillion, 120% of GDP. Annual interest payments approaching $1 trillion. Consumer debt, credit cards, auto loans, student loans, over $17 trillion total. Total U.S. economic debt exceeds $90 trillion, 320% of GDP. The Fed has run out of ammunition. From 2008 to 2022, the Fed printed over $8 trillion. Investors learned a simple rule. Buy the dip, the Fed will save you. But here's the problem. The Fed has already exhausted its weapons. Interest rates stayed near zero for a decade. The balance sheet expanded from $800 billion in 2008 to $9 trillion by 2022. To combat inflation, the Fed raised rates from 0% to 5.5% in 18 months, the fastest rate increase in 40 years. This stopped inflation but created a new problem. Higher rates make existing debt more expensive. Rates too low, inflation returns. Too high, debt becomes unpayable. The Fed is trapped. Historical comparisons, 1929 and 2008. 1929. From 1924 to 1929, stocks rose 400%. Margin debt reached 10% of GDP. Economists used the phrase permanent plateau to describe the new era where crashes were impossible. Then October came. The market fell 89% over 3 years. 2008. From 2000 to 2006, housing doubled. Mortgage debt reached 100% of GDP. People believed home prices never go down. Subprime mortgages started defaulting. The financial system collapsed. The S&P fell 57%. Both times, same story. Asset bubble, excessive leverage, widespread belief in permanence, then a trigger, then cascading liquidation. The 2026 crash will follow the same pattern. We have the bubble. We have the leverage. We have the belief that Fed intervention makes crashes impossible. We just need the trigger. The 3 most likely triggers. Trigger 1. Commercial real estate collapse, most likely. U.S. office buildings have 40 to 50% vacancy rates. Remote work is now permanent. These buildings have mortgages financed at 3% interest that are now coming due and must refinance at 7 to 8%. The math doesn't work. Owners are choosing to default. From 2025 to 2027, $2 trillion in commercial mortgages mature. If 30% default, that's $600 billion in losses. Who holds these mortgages? Regional banks. They have 20 to 40% of their loan portfolios in commercial real estate. The 2023 collapses of Silicon Valley Bank, Signature Bank, and First Republic were just the beginning. If commercial real estate defaults cascade in 2025 to 2026, we could see 50 to 100 regional bank failures. Trigger 2. Major corporate bankruptcy or sovereign debt default. Hundreds of companies issued bonds in 2020 to 2021 at low rates. Now they're maturing and must refinance at 2 or 3 times the rate. If a Fortune 500 company defaults, it triggers contagion. Investors panic sell other corporate bonds. Yields spike. Borrowing becomes impossible. More defaults follow. An emerging market sovereign debt default is even bigger. Turkey, Argentina, Pakistan. If any defaults on dollar-denominated debt, it triggers a global credit crisis. Trigger 3. Geopolitical shock. War, pandemic, terrorist attack, election crisis. Any event that spikes volatility and forces investors to sell assets to raise cash. COVID in March 2020 was this type of trigger. The 5 stages of the crash. Stage 1. Initial shock. The trigger event happens. Markets drop 10 to 15% over a few days. Investors are surprised but not panicking. They see it as a buying opportunity. Media interviews analysts who say fundamentals are strong. This is temporary. In 1929, Black Thursday dropped 11%. Bankers pledged to support the market. Stocks recovered slightly. In 2008, Bear Stearns collapsed. Markets dropped 15%. The Fed arranged a bailout. In 2026, it might be bank failures or a wave of corporate defaults. Stage 2. False recovery. After the initial shock, markets stabilize or even rise, lasting weeks or months. This is the most dangerous stage because it convinces people the worst is over. After Black Thursday in 1929, the market recovered for a week. By early November, stocks were nearly back to pre-crash levels. Then on November 11th, the market dropped 13% in a single day. The real crash began. In 2008, after Bear Stearns collapsed, markets stabilized through summer. Many analysts declared the bottom was in. Then Lehman Brothers fell in September, and markets dropped 40% in 6 weeks. The 2026 false recovery might last 3 to 6 months. Initial bank failures or corporate defaults get blamed on specific mismanagement. They're isolated. The Fed cuts rates modestly, markets rally. But beneath the surface, problems are spreading. Stage 3. Cascading collapse. The real crash happens. Forced liquidations, margin calls, panic selling. In 1929, the cascade lasted from November 1929 to July 1932. The market fell 89%. In 2008, it was faster. September 2008 to March 2009, 6 months, down 57%. The 2026 cascade will likely be 12 to 18 months, peak to trough down 50 to 70%. The cascade mechanism. Leveraged investors get margin calls, forced to sell. Institutional investors face redemptions, must sell to raise cash. Algorithmic trading amplifies declines, stop-loss orders trigger. Liquidity disappears, everyone's selling, no one's buying, stocks gap down 10 to 30%. Credit markets freeze, banks stop lending, companies can't refinance and default. During the crash, the economy enters recession. About $30 trillion in market cap could evaporate. Consumers feel poorer and cut spending. Businesses lose revenue and lay off workers. Unemployment rises from 4% to 9 to 10%. It's a feedback loop that turns market crash into economic depression. Stage 4. Maximum panic. This is the bottom. Fear is so extreme people are selling everything at any price. The 1929 panic bottom was July 1932. The Dow at 41, down 89%. Unemployment at 25%. In 2008, it was March 2009. The S&P at 666, down 57%. Unemployment at 10%. In 2026, it might be late 2027 or early 2028. The S&P currently at 6,000 could fall to 2,000 or lower. Unemployment at 10%. This is the moment of maximum fear and maximum opportunity. Stage 5. Slow recovery. Massive government intervention begins. In 1933, Roosevelt launched the New Deal. Recovery from 1929 took a decade. Stocks didn't return to 1929 levels until 1954, 25 years later. In 2008, the government bailed out banks. The Fed printed $3 trillion. Congress passed stimulus. Stocks hit new highs in 2013, 4 years later. Full economic recovery by 2015. In 2026 to 2027, the government will intervene again, bigger. The Fed will cut rates to zero. Congress will pass trillions in stimulus. Banks will be bailed out. But recovery will likely be slower than 2008 because debt levels are higher. Government debt is already 120% of GDP. Adding trillions in stimulus pushes it to 150 to 180%. Recovery could take 5 to 10 years. Stocks might not return to 2025 levels until 2032 or later. Who gets destroyed? Who profits? Who gets destroyed? Middle class holding stocks and real estate. 401k retirement accounts drop 50 to 70%. A $500,000 account becomes $200,000. Decades of savings vanish. Homeowners who bought recently will see values drop 30 to 50%. Retirees. Someone 65 years old with $800,000 in retirement savings will take catastrophic losses. Small business owners go bankrupt when consumers stop spending. In 2008, 170,000 small businesses closed. In 2026, it could be more. Leveraged investors get completely wiped out. They don't just lose their investment, they end up owing money. Who profits? Cash holders. Investors who sold stocks before the crash and held cash. When stocks drop 60%, cash doesn't drop. It gains purchasing power. Buy stocks at 40 cents on the dollar at the bottom. Buy foreclosed homes at 50% of peak values. Buffett is holding $325 billion in cash in 2024. When the crash comes and he deploys it, he could make hundreds of billions. Short sellers, betting against overvalued stocks or sectors. In 2026, commercial real estate, regional banks, over-leveraged companies are short targets. In 2008, Paulson shorted subprime mortgages and made $20 billion. Gold holders. In 1934, Roosevelt revalued gold from $20 to $35 per ounce, up 69%. From 2008 to 2011, gold went from $800 to $1,900, up 137%. In 2026, gold could go from $2,700 to $5,000 or higher. Distressed debt buyers. When companies go bankrupt, their debt trades at 10 to 30 cents on the dollar. Vulture funds buy it. Wait for restructuring. Recover 50 to 100 cents. Real estate investors with cash. When foreclosures surge, they buy at auctions for 40 to 60% of value. Blackstone bought 80,000 homes from 2009 to 2012 at crash prices and made billions. Private equity firms. They've raised $2 trillion in dry powder waiting to deploy. During the crash, they buy liquidated companies at 30 to 50 cents on the dollar. This is wealth transfer, from the middle class holding stocks and real estate through the crash, to elite investors who sold early, shorted during, and bought at the bottom. Crashes don't destroy wealth, they transfer it. From those who didn't see it coming to those who did. 2026 versus 1929 versus 2008. The comparison. Similarities. Bubble mechanics. Asset prices disconnected from fundamentals. Leverage. Margin debt. Subprime mortgages. Corporate/consumer/government debt. All at records. Belief. This time is different. Every bubble thinks this. Cascade mechanism. Forced liquidations trigger more liquidations. Credit freezes. Wealth transfer. Those holding cash, gold, short positions profit. Those fully invested, leveraged, unprepared get destroyed. Differences. Scale. 1929 U.S. stock market was worth $80 billion. 2008 was $12 trillion. 2026 is $50 trillion. Scale is 4x larger than 2008. Losses could be $30 trillion. Speed. 1929 took 3 years to bottom. 2008 took 6 months. 2026 could be faster. Algorithmic trading, global interconnection, instant information make everything faster. Could be weeks instead of months. Global interconnection. 1929 was primarily an American crash. 2008 was a global crisis, but emerging markets recovered quickly. 2026 will be truly global. China, Europe, emerging markets all interconnected. A crash in one region spreads instantly to all regions. Government response capacity. In 1929, the government initially did nothing. In 2008, they had tools. Rates at 5% gave room to cut, had fiscal space to spend trillions. In 2026, rates are already low, government debt already at 120% of GDP, Fed balance sheet already massive. Less ammunition. Response will be bigger but less effective. Timeline projection. Early 2025, now markets at historic highs, valuations extreme, leverage at records. Mid-2025, early 2026. Trigger event. Wave of bank failures. Major corporate bankruptcy. Geopolitical shock. Markets drop 10 to 15%. Initial shock. Spring 2026. False recovery. Markets stabilize or partially recover. Media declares crisis over. Summer-fall 2026. Cascade begins. Defaults accelerate. Credit freezes. Markets in free fall. Down 50% over 6 to 9 months. Late 2026, mid-2027, panic bottom. Unemployment at 10%, bank failures, government intervention. Fed cuts to zero, Congress passes stimulus. Late 2027 to 2030, slow recovery. Markets stabilize then rise. Economy slowly recovers, but stocks don't return to 2025 levels until 2030 or later. This timeline could compress or extend by a few months, but the sequence is locked. The pattern says the crash happens late 2026 or 2027. The pattern has been right twice before. Response strategy. This isn't financial advice, but pattern recognition based on what worked in 1929 and 2008. Reduce stock exposure to 50 to 60%. Hold rest in cash or treasuries. Hold 5 to 10% in gold. Make a list of quality companies you'd want to own. When the crash comes and they're down 50%, buy them. Mental preparation. The hardest part isn't strategy, it's having the courage to buy when fear is maximum. Protect your income. Reduce personal debt. Build emergency fund. Watch the indicators. Commercial real estate default rates, regional bank stocks, high-yield bond spreads. The 2026 crash isn't certain. Maybe the Fed achieves a soft landing. Maybe valuations normalize gradually. But the pattern says no. Twice before, when conditions aligned like they are now, the crash followed. The setup is complete. The bubble is inflated. Leverage is extreme. Belief in permanence is widespread. We're waiting for the trigger. When it comes, the 5-stage pattern will play out. Wealth will transfer from the middle class to those correctly positioned. Lives will be destroyed. Fortunes will be made. 10 years from now, economists will write papers analyzing why no one saw it coming. Even though the pattern was obvious. The pattern doesn't guarantee a crash. But the pattern has been right twice before. The pattern says late 2026 or 2027, the crash comes. The Great Depression. The financial crisis. The coming 2026 crash. 3 times, same pattern, same sequence, same wealth transfer. The only question is whether you'll see it coming or learn the pattern the hard way.